3D Budget personal budgeting software introduces a unique concept called budget reconciliation. This is the process of validating your budget and aligning it with your actual funds. 3D Budget is the only personal budgeting tool that has the capability to reconcile your budget with your true financial position and provide a single indicator of your financial health. This video will cover the following items. What is reconciliation and why is it important? How does the reconciliation calculation work? What are the steps in the reconciliation process? And how often should you reconcile your budget? What is reconciliation? Budget reconciliation refers to the process of aligning your budget with your true financial position. When you reconcile a spending budget, you compare your budget assumptions to the amount of money you really have available. On the left, your budget assumptions represent the amount of money you have allocated to spend in each category. On the right, your available funds are made up of checking accounts and cash with adjustments for credit obligations. This reconciliation is necessary to verify that the expenses you captured in your budget match your actual outflow of money so that you don't allocate more to the budget than you actually have. Why is reconciliation important? Picture the scenario shown in these slides. You start with the funds depicted on the right and the budgeted amounts depicted on the left. The assumption is that you have enough funds to cover your budget. For example, you would only budget $100 for food if you have $100 to spend. In week 1, you have expenses, so money flows out of your accounts, and you in turn adjust your budget to account for these expenses. But what if there are some expenses, depicted with the different color money, that you overlook? These don't get reflected in your budget because you forgot to write them down. This is especially easy to do with cash expenses. In week 2, you receive some income, and your budget gets updated to reflect the new funds. In week 2, you also have expenses, so money flows out of your accounts, and the affected budget categories are reduced. And invariably, there will be some cash expenses that get overlooked. In week 3, the same thing happens. You receive income and budget it. Your expenses are captured, except for some small, overlooked amounts. In week 4, as before, income is received and expenses flow out. In week 5, the same thing happens, and by now you should be able to see the issue. Your available funds are gradually getting smaller and smaller because you are spending more than you are receiving. But your budget assumptions have been fairly stable. The total budgeted amount is about the same as it was in the beginning of week 1. Now, when expenses flow out, even though they are the same as previous weeks, your available funds are almost depleted. But your budget does not reflect this critical situation. These slides show how overlooked expenses can add up over time. Your budget will tell you that you can still spend money, but your bank accounts will be empty. This is why you need to reconcile your budget with actual spending on a periodic basis. Reconciliation will highlight the difference between budget assumptions and available funds, and it will prompt you to adjust your budget accordingly so you don't spend more money than you have. How does the reconciliation calculation work? The objective of reconciliation is to make sure that your budget is aligned with your funds. 3D Budget has a patented reconciliation formula that calculates the difference between your budget assumptions and your funds position and provides an indicator of your financial health. The first step in calculating is calculating your available funds. Available funds is the sum of your checking or savings account balances, the total amount of cash you have, and also the total of any receivables that you are expecting. Receivables are things like expenses that you will be reimbursed for by your employer or short-term loans that you gave to others. Receivables are considered available funds because they will soon be available for spending. And in order to get a true picture of available funds, we need to subtract your credit obligations. This includes credit and charge card balances and any other short-term debt you owe. Credit is subtracted so that you know what your true position would be if you paid off all of your credit cards immediately. 3D budget refers to this result as your current assets. Everything except for cash is calculated automatically by the application, and you can review this value at any time by simply opening the reconciliation screen. The second step is calculating your budget assumptions. Budget assumptions are also made up of 4 elements, the first of which is budgeted available. This is the sum of the balances of all of your spending budget categories. It represents the total amount that you have allocated for spending and which has not been spent yet. In other words, if you allocated $100 for entertainment and you had only spent $60 so far, budgeted available would be $40. The next 3 elements are all related to income. Undistributed income is income that has already been included in your budget assumptions, but has not yet been allocated to any spending categories. This is income that is available for allocation and spending at any time. To be budgeted income is income that you have received and will be added to the budget assumptions, but which has not yet been added. If you set up income with automatic biweekly or monthly allocation, then only part of this income is included in the budget each week. To be budgeted income represents the remainder that will be included in coming weeks. The third income element is early income, or late income if it is a negative number. This is where you tell 3D budget if you have any paychecks that were received early or late. This is necessary so that 3D budget knows how to evaluate the money in your bank accounts. We can refer to the total of these 4 elements as assumed assets. This is what your available funds should be according to your budget assumptions. As with current assets, everything except for early income is calculated automatically by 3D budget and can be reviewed at any time in the reconciliation screen. If we subtract assumed assets from current assets, the result is what 3D budget refers to as free assets. This is a very valuable figure because it tells you how much money you have in your accounts, which isn't spoken for as debt or as budgeted spending plans. This figure can be calculated at any time and is always comparable to previous calculations. Therefore, you can use it to target a comfort level where you will always have funds available when needed. For example, you could target $2,000 of free assets, and as long as your budget balances do not become negative, you will always have at least $2,000 in your bank accounts. The ideal level of free assets will differ by individual and depends on your average credit balance and the variability of your expenses and income. The final calculation in the reconciliation formula is calculating the change in free assets. Free assets minus free assets calculated during the last reconciliation equals the change in free assets. This value tells you what has not been accounted for in your budget since the last reconciliation. There are 3 reasons for a change in free assets. First is overlooked expenses. This is the most important piece because these are cash expenses that you simply forgot about. They will whittle away at your available funds, so you need to make sure they are accounted for in your budget. Overlooked expenses will reduce free assets, but you should always zero them out by entering these expenses in 3D budget as part of the reconciliation process. The second is unbudgeted expenses. These are expenses that you entered in 3D budget, but which you purposely chose not to assign to any budget category. You create these expenses by assigning them to the special budget category called free. The reconciliation process reminds you about these expenses because they will reduce free assets. Third is unspoken for income. This is new income that has not been included in your budget assumptions. It is either income from a source that is not one of your automatically allocated income sources, or it is income from your standard income source that is in excess of the normal allocation. For example, if you normally assume $1,000 per month in income, and this month you received $1,100, then your unspoken for income would be $100. Unspoken for income will increase free assets. This is the end of part 1 of the reconciliation tutorial. There are 2 sections in all. Please click the link to proceed to part 2 to walk through a sample reconciliation in 3D budget.